But lots of market perspective to get in. We have with us Gustavo Medeiros from the Ashmore Group joining in on the show right now. Gustavo, hi, afternoon. Welcome to ET Now. Thanks for taking the time out. Amidst the high drama which is still playing out between the red and the blue camp, and we're still awaiting a clear mandate as to who's going to be occupying the White House next. For the market, Gustavo, amidst the choppiness that we're seeing today, what's in it for them?
Hi, good morning. Thank you very much for having me here. Yes, indeed, it seems like we won't know who is going to be the next president, at least for a couple of days, but potentially even for a couple of weeks. And given the statements of the president, we should expect some choppiness ahead to the extent that markets don't like uncertainty. And it sounds like we're going to get still a little bit of uncertainty in regards to the result of the US presidential election here. It's interesting to see that 10-year treasuries, for example, are trading down at 0.79% in terms of yields, which is 15 basis points lower than the highs that it hit overnight. And the US dollar is going up. The dollar index is rising about 50 basis points as I speak. But equities is also going up, driven by tech stocks, as you mentioned correctly. In the case of India, is also the case globally. This combination is a bit unsustainable. We need to get more certainty in regards to the fiscal expansion and in regards to the coronavirus before we can validate any significant move higher on equities. But the market seems to be getting ahead of those in spite of the uncertainty.
Gustavo, if the verdict so far appears slightly different than, or very different than what Wall Street was betting on, how come there is no panic? Why are Dow futures not down 1,000 points? Why are Nasdaq futures not down 5%? Why Europe is down but not completely out? Looks like markets not nervous despite there is uncertainty about who's going to be the next president of US.
Well, I think this uncertainty has been relatively well telegraphed. We've been talking about that for at least a couple of weeks now within our investment committee, and also right in our research publication, that it's not, like we always knew that if Florida wouldn't have had a clear Biden win, then the scenario could become complicated. And given the fact that many of the swing states will have a lot of postal votes that will be coming late, given that they only allow the counting of these votes to start on election day, then it was always quite high likelihood that we wouldn't know who is the president on election day, or on the evening of the election, or one day after. The issue here, I think, that is going to be most important is whether or not we're going to see an aggravation of the uncertainties driven by violence or driven by a court dispute that can lead to more market uncertainty and choppiness. But again, I think that the market is not overreacting just simply due to the fact that it was somewhat expected, these outcomes so far.
At what point in time you would say you will be a buyer if markets fall because of uncertainty or profit booking? Because in the run-up to the election last week, US markets had already fallen a good 5-6%. Do you think this is a good time to put money to work for those who missed on, let's say, the April to the September rally? Is it a good time to put money to work ahead of Christmas?
Well, I think that there are some pretty clear medium to long-term trends that you can take advantage. The most clear one to us is that the US dollar is likely to depreciate over the next 3 to 5 years, basically on the back of the very large current account deficit that the US is running. And actually, this current account deficit has been deteriorating in spite of the economic recession that the US is going through, due to the fact that the US doesn't produce many of the goods that it needs to purchase today, such as protective equipment, but also technology goods that comes primarily from Asia. I think that the US dollar is likely to be for sale regardless of who is going to be the next president of the United States. to the extent that the current macroeconomic situation will demand higher fiscal expenditure. And you can argue that with Joe Biden, you'd have a larger fiscal expansion at the beginning, which would be very, very bullish for markets overall, but also very bearish for the dollar initially. Whereas with Trump, it's likely that we're going to see, particularly if Trump gets elected without getting the Senate, it's likely that we see some political clash before we can agree on a potentially smaller fiscal package, which obviously would mean a bit more uncertainty in the short term in regards to the fiscal expansion. But again, in either scenario, it's very likely that the dollar will depreciate because some degree of fiscal expansion will drive the current account deficit in the U.S. higher. And twin deficits at a stage that the economic cycle that the U.S. is running at the moment is quite negative for the dollar. If the U.S. would be an emerging market economy, the U.S. dollar would have sold off to a much larger magnitude so already, and would have much more downside. We think that the downside is still there. It's just that the trend hasn't started in a meaningful way yet.
Gustavo, there's been all this talk about rotation, particularly in the US markets. Do you think that will perhaps have to pause while markets take stock of really which way these elections will go?
Well, the rotation discussion is really about the momentum stocks and the technology stocks that have been driven by very low interest rates, but also driven by the secular trend of movement from high street towards technology retailing, which actually is a secular trend which just got anticipated. The problem of these stocks is that the valuations implied on them are extremely high. And a good part of that is, again, there is not a lot of alternative if you want to be on a conservative place where you actually find, on a decent time horizon, some opportunities. And with the cost of funding, i.e. interest rates at all-time lows, then it becomes a bit of an easy bet, if you will. The rotation is therefore dependent on a much more broadly, more structural rotation, which will allow for banks to recover, allow for the economic activity to recover normally, and oil prices to stop bouncing around the lowest levels that we've seen in many decades in real terms. And that would allow for the beaten down sectors like energy, like banks, and the retailing on the more kind of like a high street sense to actually outperform. So for that, we need a combination of resolution of the coronavirus healthcare crisis, possibly via vaccine, but also potentially via better therapeutics, which allow people to go out normally with their lives. And I don't have to talk about, we can go back to our offices and resume our life as it was before, but also some fiscal stimulus. So we need both of those things happening for the reflation trade to work. And the reflation trade will lead to the rotation that you mentioned.
And clearly those are some of the other critical factors markets will be eyeing even after these elections. We'll leave it there. Thanks for joining us. We need to take a very quick break. Back in just a moment.